And can I tell you that for 2025, £9.5 billion was taken out of UK equity-focused funds. And that is the 10th year in a row that has happened.
The US wanting to double their defense spending in 2027. Now, they already spend $900 billion a year. He's talking about raising that to $1.5 trillion. Now, at $900 billion, that is already more than the whole of the next biggest 9 countries' total defense spending put together.
Every dog has its day.
Yes.
These are the caps we bought 6 weeks ago, and I can tell you they're probably originals.
Yeah.
No one else has done this.
We're calling him the Trump now, are we?
We can call him whatever we like now.
Should we be calling him El Presidente now, Spice? What happened in Venezuela? Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome back, everybody. It is episode 27 of The Art of Investing, brought to you by IG, the global investment platform. Now, introducing my co-conspirators. It is CJ Butch Cassidy Fellingham and the Spice Dance Kid himself, Mark Holden. Gentlemen, welcome back.
Thank
Happy New
you
Year.
for having us back. Was it your New Year's resolution to try and be more funny than normal?
Not possible. Carrying on the habit of a lifetime. Now, CJ, talking of which, Happy New Year to you, but I was terrified for you because you would be the type to be stranded in St. Bart's there, whereas the airspace was closed over New Year for the Caribbean.
No, I wasn't over in the Caribbean. I was spending my time at home domestically in the UK, enjoying the grizzly weather, the grey days, and now the freezing cold temperatures.
Well, we're back into it. First week of the new year. What have the listeners got to look forward to today?
Okay, so a special one today because it is the one to celebrate the end of the quarter. And so first of all, of course, we'll have Mark's review. We'll hear about what's happened. Should be quite short because not much has been going on, as we know. And then we're going to look at the portfolio. We're going to look at how it's performed since our last podcast, which was the 17th of December. And then we're going to look at the quarterly performance of the asset classes that we own. And let's just then have a free-for-all around what are we thinking about those now, what has changed, and do we want to make any change to the portfolio for the next quarter coming up, which should be very exciting.
Okay, so stick around. You're going to hear our thoughts on every single one of our positions in our portfolio and perhaps a little bit on what we don't have as well. Spice, good Christmas. Looks like you've maybe got GLP-1 trials come to an end, is it?
Yes, that turkey is offset, definitely. That's why I'm going
and
for
he's
dry
obviously
January.
got a new shirt as well. He's
Yes.
gone for the for the yellow look.
Was it Toy Story? Was it Woody?
I think it's probably jaundice with a
he
bad
does look
liver.
bit like Woody, doesn't he?
Right, shall we crack on? Spice market update, take it away.
Absolutely. Well, as ever, it was an eventful Christmas period. And although Santa's rally and his sleigh got slightly delayed, he managed to make it through in the new year. So the rally came through, particularly in equities and commodities. Basically, great end to the year and beginning of this year. We've had equities hitting new all-time highs in most of the American markets, the S&P, the Dow, and the Russell. We also had Europe doing actually quite well, catching up after a bit of a delay. So the DAX and Eurostoxx hit highs. Japan, Nikkei hit new highs, and as did emerging markets. But guess what? The FTSE 100 made the magic 10,000.
Well, can I just say on that, because one of the things that should make us feel a little bit disappointed was a bit of news that came out over the break of the flow into and out of UK equity-focused funds. There's a firm who calculate this every month as they see inflows and outflows out of regulated products, and they produce those numbers. And can I tell you that for 2025, £9.5 billion was taken out of UK equity-focused funds. And that is the 10th year in a row that has happened.
Wow.
In October, over 3 billion was taken out. And in November, over 3 billion was taken out. Why would that be? Was there something that was happening at the end of November? Oh, yes, it was the budget.
Yeah.
And of course, everybody was running for the hills in case capital gains tax was put up or there were any other changes. And so it just shows the damage that all this talk has done to flows into the equity market. But on a positive note, as Mark says, we are long-term investors. And we took the view 6 weeks ago that the FTSE was going to take out 10,000 and that should be a really, really proud day. So guys, every dog has its day.
Yes.
These are the caps we bought 6 weeks ago. And I can tell you they're probably originals.
Yeah.
No one else has done this. And if anybody wants to buy them, put a bid into charity and you can have our caps.
Oh, we hadn't discussed
We
that
didn't discuss
before. This is going on my shelf forevermore.
So well done, the FTSE. 10,000 taken out.
Yeah.
At last. It's taken an awful long time compared to other markets. It's huge underperformance. You can see from these amounts of money flowing out of UK equities how difficult it's been. But just imagine how good the rally could be when that outflow stops.
Wow. So Spice, the level 10,000, it doesn't really mean that much, does it? But what kind of landmark is this for the UK?
Well, I mean, equity investors love psychological levels. You know, if a share price gets to £1, it often oscillates around £1 and then goes to 2, 3, 4, 5, and eventually gets to 10 and then oscillates around 10. And equity investors are just sort of weird like that. But it means nothing really. The valuation of the UK market is still one of the lowest in the world. So it's very good value compared to other markets. And actually, growth is meant to pick up a bit this year in terms of earnings per share. And it's still valued at about a 25% discount to the US markets.
Are you implying equity investors are quite simple, Mark, in that they look for round numbers?
Well, it hasn't stopped me trying to earn a living out of it. But no, I mean, it's just good to get over that psychological level. Now, you know, the chances are we'll chop around this level and then move on again. So, you know, it'd be nice to see it move on up, and no reason to think it wouldn't do, because the UK market is blessed with a lot of mining companies, which we'll talk about later, which have been benefiting from commodities, and defence companies and companies that earn lots of money from outside the UK, which is the irony with people selling because they're worried about the UK. And actually, the FTSE 100 has over 80% of its revenues coming from outside of the UK. So there we go. I think more interestingly, actually, was the fact that where we didn't see all-time highs, so Nasdaq lagged a bit, and those are the ones. Remember, the big technology exposure, and the Magnificent Seven make up a large proportion of that index, and also India, which we own. But we'll talk about that more when we go through the portfolio a bit later. Talking of India, the market got hit quite hard again today, about 1.5% down, and that's because Trump is threatening 500% tariffs on India.
Is this still over Russian oil imports?
It is all about Russian oil. So he's obviously trying to sort of get the pressure back on Russia to do a peace deal in Ukraine, because he wants to win a Nobel Prize for Peace Man of the Year. But remember that tariffs in India are already 50%. So 500%. We've seen him do this. He did it in China, etc. There's a lot of bluster, and quite often he reins back from that. But it hit the market, the equity market today are down about 1.5%. So clearly not the end of the world, but it hurt them a little bit. As we go into this year, the S&P 500 earnings expectations for about 14% growth this year. And that's up from about the sort of 12-13% that's probably been delivered in 2025. We'll get numbers as companies come through in the next few weeks. But that's pretty good growth. It's the long-term average is sort of 8 or 9%. So that's a really good year coming up, which is one of the reasons markets have made it to all-time highs.
And how does that break down, Mark, between the Magnificent Seven and the rest? I mean, is it very heavily skewed towards the Magnificent Seven, maybe, I don't know, doing 25 and everyone else doing about 6 or 7 or what?
Well, it's less skewed than it has been for many years, actually. For the last few years, the Magnificent Seven have been doing 25 to 30% earnings growth, and the rest of the market has been lagging around 4 or 5%. This year, the Magnificent Seven are still expected to do really well, 20%-ish. But actually, there's a broader spread this time of earnings pickup. And as you know, I've been quite a sort of advocate of looking into the Russell 2000 as you see this broadening out from the Magnificent Seven into broader stocks. And for example, the Russell 2000 is expected to produce about 20% earnings growth this year. Now, that's off a low base because a lot of companies in the Russell have actually been losing money or making no money at all. But as the economy starts to pick up in the US and some of the benefits of AI and one big beautiful bill and the tax rebates that are coming through in the US.
That's one thing I've not missed. That's one thing I've not missed over this break.
Yeah, well,
just chatting with the family. No one's mentioned the one big beautiful bill at all. Here we come, straight in, and there we are.
That wasn't the dinner table chat?
That wasn't the dinner table chat. There were many things that were, but one big beautiful bill wasn't.
So, I mean, if you look at the valuation, the S&P 500, like I say, is meant to produce about 14%-ish earnings growth this year. It trades on about 22 times forward price earnings ratio. Remember, that's the way we measure the valuation of these markets on a broad sense. The NASDAQ, which is mainly tech, as you know, NASDAQ 100 is actually going to produce around that 15 to 20% growth because it's got a bigger weighting to the Magnificent Seven, which are going to produce around 20% growth. That trades on about 25 times forward PE. So it's more expensive, as you would expect, because it's producing more growth. But going back to the Russell 2000, that's producing about 20% growth, but only trades on about 17 times forward PE. So it looks there's value there. And if you look at the FTSE, even this year, we expected for the first time in a long time to produce double-digit earnings growth in the UK, about 14%. So the same sort of as the S&P 500. And yet it trades on about 15 times forward PE. So actually, price-earnings ratio, the FTSE 100 still looks good value.
You could say it's a third undervalued compared to the S&P. If it was consistent growth. I mean, that's the problem, isn't it? It's one-off this year, maybe below again next year. But if it was to be able to move up there, then that as you say, that gives an idea of how much the FTSE is cheap if it could grow at that level.
Yeah, value still has a place in
Come on, Rachel, get the growth going.
If they deliver the growth, then that'll be good. I mean, look, the FTSE 100 is never going to trade on the same valuation as the US, just because of lots of strategic reasons, makeup of the indices in different ways. Some of the companies in the FTSE 100 are naturally lower price earnings multiple valuation sort of sectors. But if they could get anywhere near that sort of, that level, then it would be an amazing run.
I think that's worth just pausing on for a second. And when you say that naturally there are sectors in the FTSE 100 that trade at a lower multiple, what does that mean?
So things like oil companies. So there's a big chunk of oil companies, basically Shell and BP in the UK. They're never going to trade on high valuations because at the end of the day, their profits will go up and down with an oil price. And the oil price is very volatile, can go up and down, and is not really controllable. Although OPEC tried to control the price, it is volatile. And that increased volatility reduces the visibility and the certainty of earnings going forward. And the less certainty and less visibility you have about how the earnings will go in the future, the lower price you're prepared to pay for that company at the moment. If you had perfect certainty that the oil price was going to $100 from $60 as it is now over the next 3 years, you would go and buy a load of oil companies. But it could easily be $50. And in which case you would have the earnings of those companies would probably go down this year. And you don't want to own shares often in companies where the profits are going down.
Yeah. And the same with supermarkets and well-established retailers. There's just never going to be that 50% earnings growth, is there?
Yeah. In America, it's got lots of these big growth companies that sometimes can pull out 50%, 100% growth. And the UK, sadly, isn't blessed with those sort of companies. But nevertheless, overall, it's still an attractive valuation compared to history, given the earnings growth is now expected, like I say, to be about 14%, which is about the same in the S&P 500. Last year is probably coming in about 8 or 9, and the year before that, about 5. So we just started to see a pickup in the earnings growth of the UK companies. That bodes well, hopefully, for FTSE 10,000, maybe 11,000 before we know it.
We could get some camps. Yeah. Hey, who would have thought of that?
So, yes.
Right, what else is going on in the world then, Spice?
Well, I mean, although we're talking about how good equities have been into the year end, actually the place that really blew the lights out was commodities. So, and a fantastic year for most commodities, led by what's called the platinum group metals, PGMs. So that's platinum, palladium, And silver and gold all had fantastic years. Copper did well as well. And we made all-time highs in all of those metals into the year end. And that was very good. Some very big moves into the year end, which is, you will see in the next few days whether that holds, but there's a bit of blow off of some of that sort of gain. And one of the reasons, we've seen people wanting to sort of be worried about what's going on in the world, and we'll talk about Venezuela and Trump in a minute. But nevertheless, some fundamentals happened because the gold price ironically went up a lot. Places like India, who are the biggest buyers of gold, because when people get married in India, they have a dowry which is made up of gold mainly. Because gold prices become so high, actually, the people have been switching into silver in dowries, I've been reading about. So there's an increase of 37% in Indian silver imports because people are swapping out this very expensive gold for silver in dowries when people are getting married. And Indians are massive consumers of gold and silver for that reason mainly. We talked about how difficult cryptocurrencies were towards the end of last year. It's stabilized over the new year, and Bitcoin is up about 6% from the last time we sort of updated people on the markets and the portfolio, which is what I call stable to small up.
Really struggled to get going. It still feels that kind of heavyweight.
Yeah, absolutely. I mean, clearly there's been a big shock to a lot of crypto, and confidence needs to be restored. These things never happen quickly when you've had such a shock and such a big aggressive sell-off. It takes time to recover from that.
CJ, our crypto expert, have you seen much over the break?
Not really. I mean, I think, we talked quite a lot before the break around how much money was lost in the October huge sell-off in Bitcoin and then the associated other cryptocurrencies. And I just think there's a lot of blood on the street still. There's a lot of people who were leveraged and had been running very long positions who got completely buried. And it takes time for that to come back. And I mean, if you look at the funding markets in crypto, they're starting to come back now. There is some signs that it's starting to go back to being a more normal funding market.
Okay.
There's a lot of confidence gone. And I was saying to Mark before, that there's always those little rumors around the corner that quantum computing is going to happen quicker than people think. And I think people think that quantum computing is a bit of a threat to crypto, and the cryptography in the machines being able to solve and break people's passwords. And therefore, there's a little bit of worry around, though no one's, people have lost so much money. I think it's going to be pretty dead for the time being.
Right.
But, it's stabilized is a good sign to start with.
When you say funding markets, what do you mean in crypto? Because, that obviously probably needs a little bit of explanation for our listeners.
It's like all markets. You can, if you take the gilt market or the treasury market or the UK equity futures, you can set up positions where you are long of a particular market and you can sell futures against it. And so net, you've got no actual position in the market, and that pays you a certain amount. Normally the risk-free rate. So you can buy FTSE futures, you sell the FTSE against it, or do it vice versa. And there's a setup financing from doing that. Those financings have all turned negative in crypto land. It just doesn't make sense anymore. People are not getting paid to actually run and finance positions in crypto. It's because people have had to get out of those positions, because people have had to rush for the exits. They've had margin calls. They just sell at any price. And it doesn't make sense where they're selling, but they've had to sell there. And the liquidity isn't there on the buy side to buy these things up. So you've had a situation where a lot of people have had to sell things at the wrong price, but that's what life's like, I'm afraid. We've all seen it throughout our careers. I mean, as you know, I've been around a long time, as has Mark, Rich slightly less. But we have seen times where things have got absolutely ridiculously stupid, and you will say, it can't trade here. No way could it possibly trade here, and it trades there.
Mm-hmm.
LTCM in the late 90s was a perfect example of expert mathematicians saying, these things can never trade at this level, so I'm going to buy in so much size because I'm going to make so much money, and then they trade at that level. And they all had to get stopped out. And all those sorts of things happen in a crisis. That's what happened in crypto. So at least now you've got a situation where things are more stable, but it will take time for that confidence to come back in.
Yeah, and slowly as the confidence comes back, you can see it in the charts, can't you? After SVB, then that was another situation where you just started to see confidence come back.
And that's what you're seeing some small signs, but it's pretty fragile out there. It will be helped by the macro outlook. We've talked last year about the fact that it's likely that interest rates will fall further. I think I'm right in saying that in January, Trump will announce who the new Fed chairman will be. And he's bound to pick somebody who's going to be regarded as a dove, or somebody who's going to cut interest rates more than people expect. And that will be supportive as well. All these things will be helpful, just need some stability.
We're calling him the Trump now, are we?
We can call him whatever we like now, because I'm afraid if you say something to upset him, he sends the helicopters in.
I'll call him Sir.
Should we be calling him El Presidente now, Spice? What happened in Venezuela?
I'll come on to that in a minute, Rich, because there's obviously a huge amount to talk about. But let's just quickly touch on bonds, because obviously they're huge markets. And although we don't really own very much in our portfolio, it's been a pretty stable couple of weeks or few weeks since we last reported. They've been broadly flat, so prices haven't moved very much, except for one exception, which is in Japan. And Japan, since we last spoke, put their interest rates up as expected by about 0.25%, and people are expecting more interest rate rises over the next 12 months, perhaps another 2 increases of 0.25% or 50 basis points in total, 0.5% over the next 12 months. And that was as expected. But Japanese bond yields, which we touched on before, and if you listen to our Christmas special and the outlook for 2026, we talked a lot about the Japanese carry trade, Japanese yen carry trade. And so this is very important in terms of funding that. And Japanese bond yields have risen to over 2% for the first time in sort of 20 plus years. It's been a big move, and it's nearly, compared to 12 months ago, it was the Japanese 10-year bond yields were yielding at about 1.1%, and now today they're at about 2.1%. So it's been a huge move, so basically prices of Japanese longer dated bonds or 10-year bonds have fallen, yields have gone up, and that's been the exception rather than the rule elsewhere in the world. And that stability elsewhere in the world has been pretty good and supported, mainly because actually, weirdly, in the last few weeks, we've started to get some good inflation data, particularly in the United States. So when we were off, basically, the US inflation came in at about 2.7%. CPI, Consumer Price Index, came in about 2.7%. It was expected to be 3.1%, and that's down from 3% the month before. And that is what sparked the year-end rally, really, more than anything else.
Yeah.
That worked really well for equities particularly. But it also did help bonds stabilise and stay flat into the year-end.
And we see an updated number this coming Tuesday, don't we?
We do. So that will be, people will be watching that very closely. And if you remember, because we had the government shutdown in the US last year, there's still sort of some mistrust about some of the data that's coming through from September, October, November. And we'll really, as we go into the new year, people will gain confidence again in the data that's coming out, and we'll be able to see really what's been happening.
So to say that another way, the CPI came out as a shock. There are a certain number of people who think, isn't it surprising that was much, much lower than expected? That suited Donald, who'd replaced various people at the data collection centers in the US, but they also had the shutdown. So as you say, I think people will be wanting to see confirmation that indeed inflation is low, or whether there were some factors behind the number that was so low, which actually have reversed out, and actually it's back up at the 3% level. And I think that's going to be quite important for people to see. Now, of course, if he pulls in somebody to be Fed chairman who doesn't really care because he's going to cut rates, that's a different subject. But then the bond market won't like that, because bonds will want to see low inflation to back up the lower interest rates.
Yeah, as long as they pick someone called Kevin, then they'll be fine for the Federal Reserve and bond markets. I mean, looking forward for the next 12 months, the sort of the highest probability is for 2 interest rate cuts in America next year over the next 12 months. And that probability is at about 31% at the moment. Whereas when we spoke before Christmas, it was about 33%. So it's hardly moved at all, despite that better than expected inflation number. Instinctively, I agree what Chris says, that, we can be skeptical of these things, but also we might be seeing the benefits of some of this AI productivity gain and efficiency gain starting to come through, which is one of the reasons that you're going to get increases in profitability in the US and these higher earnings per share expected around the world. with that, as we know, we're worried about potentially the impact on employment, particularly for the youth. And we'll be watching that very closely as we go through the year. So on to the main event, really, which has only happened sort of into the new year, I think on the 3rd of January, so just less than a week ago. Obviously, Donald sort of threw his...
Delta Force.
He threw his toys out the pram, I think is what we're saying.
Yeah, I mean, it's really interesting because if you listen to our outlook on the beginning of January, we had highlighted the fact that we thought one of the themes for this year, 2026, could be that we would see increased volatility around Trump. And as we head into the midterm elections in November, we were speculating, as it turns out quite correctly, but you've got to get lucky sometimes, that we would likely to see some sort of strange moves from Trump as he tries to begin electioneering almost and get ready for those midterm elections. And he'll pull every lever he can. We were thinking a lot of that might be economic, but he's clearly decided that he's going to do some other things. So
a special military operation.
Absolutely. But before that, on Tuesday this week, he basically has banned institutions buying family homes in America. So that means he's going to try and keep the cap on house prices in America, in fact, drive them down a bit, which is popular. That's great for the lower paid people. And that's good for, the underlying wealth of those people. So he's saying, I don't want institutions buying up big chunks of houses and then selling them at a big profit. He's stopping that, which is, I think, probably, to be fair, quite a good thing to do.
Wonderful thing.
Although, this is a capitalist economy and it's going completely against capitalism. But hey, when has Trump been a capitalist? But, the other thing is as well, overnight, and this is Thursday, we're talking today, he's talked about the US wanting to double their defense spending in 2027. Now, they already spend $900 billion a year. He's talking about raising that to $1.5 trillion in 2027. Now, at $900 billion, that is already more than the whole of the next biggest 9 countries' total defense spending put together. So the US is already massively outspending everyone else. And he's clearly going for it.
But he cannot afford it. That 500 billion additional, he cannot afford it. He's got interest payments that are going upwards of $1 trillion. And his welfare payments, he's not about to suddenly slash those. So you can't just add that into the deficit because the bond market blows up and it doesn't finance it.
First of all, what he says and what he does, we don't know whether that's actually going to come through or not. But he will claim that tariffs will pay for it all. I think he has done already. So tariffs are going to pay for all the growth and it's going to pay for all this. It's going to be very interesting to see how those numbers add up. I mean, there's no doubt you will see more issuance. You will see more bonds. And that's where the pressure starts to come. But he doesn't believe in a balanced budget in any way, shape or form. Remember, he's a real estate developer. And, I've gone down this route with people here before. But, basically, you borrow loads of money, you buy something, you put a very small slice of equity in there, interest rates get cut, the value of that property goes up, you sell it, you pay back the debt, and you made a very big return on your equity. That's what property developers have always done. When interest rates go up, they file for bankruptcy and give the building back. And so they only lose that very small slice of equity. The debt holders lose a load of money. And I'm afraid that is capitalism 101 as far as real estate developers are concerned. So I am not at all concerned that he believes debt's a great thing. Get interest rates down. It's what he's done throughout his life. And it's made him a very rich person because when someone's left carrying the baby, it's never him. That's what's happening here as well. And markets will stay comfortable with it while they still see that the bond market behaves itself. We've talked about this before. When the bond market starts misbehaving, a lot of this will come unstuck, but it ain't yet.
And what he has done on the subject of Venezuela, it's genius because the oil price now very much has a cap on it, like the three of us. And
not at 10,000, thankfully.
That's going to help inflation greatly. So if you see $52 to $57 oil and it's stable around there, then we can see inflation down to under 2.5%, which means you can cut rates and everything's happy days.
There's a great correlation. I haven't got it here today. I'll dig it out maybe for the next time between low energy and oil prices and growth. I've met luckily in my life, some of the most successful investors in the world. And almost to a person, they will tell you that the secret behind the money they have made is to back growth where energy prices are very low.
Wow.
Now, look at the US economy and how well that has grown with the low prices they have for their energy. Look how terribly we have grown in the UK with our very high prices for energy. I've no doubt in my mind that part of the reason for this, what he's doing, is to keep a cap on energy prices, because everything he announces, go back to what the previous bit of our conversation about putting more money into defense, everything is about growth happening, taxes coming in, spend the money. Go back to the UK, the problem here is we've spent the money with no growth and nothing coming in, which is why we have a problem. They have that growth, I think, in terms of ensuring that growth continues. What he's done is a very logical thing because he will keep that oil price down from doing it.
I think it's worth remembering, we talked about the oil blockade of Venezuela and why actually it wasn't that important overall, because Venezuela only produce around 1 million barrels of oil a day. And the world consumes over 100 million barrels of oil a day. So it's less than 1%, give or take. But in its heyday, Venezuela, back in the 70s and 80s and 90s, were producing 3.5 million barrels of oil a day, which is far more significant. In fact, at one point in the 70s, they were producing 6 or 7% of all the world's oil that was being consumed. So nearly as big as Saudi Arabia. Now, Venezuela, as we've talked about, have got the biggest oil reserves, proven oil reserves in the world, on the planet. Bigger than Saudi Arabia. And so therefore, if you start to invest in that oil industry, which hasn't been invested in because he nationalized a lot of the oil companies and he pushed out a lot of American companies, which is why Trump has
He stole American money.
Exactly. That's why Trump is justifying going back into Venezuela, because they stole American money and they stole American companies' sort of assets. He's going back in. And this is from sort of 20 years ago. He can justify that. But he's talking tomorrow, which is Friday, which is the day this podcast comes out, with all the big oil companies in America. Chevron is the only big company that still operates in Venezuela from America. And he's going to try and persuade them to accelerate their capital expenditure to get that growth going. Ordinarily, it would take 3 to 5 years to get some really good, strong oil production growth out of that. But with modern techniques, that could be a lot quicker than expected. And it was very interesting. When the news first broke about Venezuela, basically the oil price went up. And people were going, oh, that's going to cut off, bizarre.
I cannot understand that.
The smart money where it started selling it and shorting it, and then was selling things and the price, hopefully the price will go down and you can buy it back cheaper. And the oil price has been falling pretty much ever since. And that's because basically, if you put these companies in America, you accelerate the sort of production and investment there, very quickly you could see a pickup in oil production from Venezuela from a very low base. It won't take much. And the world oil supply and demand is very much in balance at the moment. If you remember, OPEC, which is led by Saudi Arabia, are trying to balance that at all times to maintain a price of around $60 on Brent. That's what we think they're trying to do. This has pushed the price down around $60. So, maybe the Saudis will have to say, oh, do you know what? We won't increase supplies if Venezuela are going to start doing that. So that you may see, there'll be toing and froing between OPEC and Venezuela and the Americans. It'll be really interesting in the next few months.
Do you like how Spice says the smart money was shorting oil? We know what he's been doing on his IG account now.
He's a prolific investor.
Long term.
They call many
Long
things.
term, short term, or whatever term suits. If we just branch out a little bit from Venezuela and think about what he is doing, I think it's confirming a number of themes that we talked about last year, where he did several trades in various rare earth companies. He talked about various commodities. It's difficult to think that he hasn't got some policy here to take more control of the Western Hemisphere, which they talked about before Christmas, and to take more control of the commodities and mineral development and all they need to be pretty much self-sufficient from any other part of the world. And you see this in what's going on in Venezuela. I mean, there's lots of talk now about Greenland and what's going to happen there. And it's the same sort of argument. This is my territory. Everyone else, go do one and get out of here.
Yeah.
And it's going to be really interesting to see whether this is just a one and done or whether this is going to keep smouldering on in the background for the next few months. Personally, I think it probably will keep smouldering on in the background because I think he's been clear. I think, as Mark said earlier, the whole of the timing is being dictated by the November midterms. He knows he's got a problem in those midterms. He's trying to do, dare I say, a Margaret Thatcher with the Falklands War. Rah, 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 we're going to take the Falklands, and everybody votes Conservative that year. People forget how unpopular Margaret Thatcher was until the Falklands War happened. Right. So you've got to be really careful that he doesn't start being more and more desperate in what he does in order to get and win those November midterms. So I think there's a question mark here as to how far the markets can continue to ignore all this stuff, ignore the rising political temperature, ignore the risk of something big going wrong, and keep that saying, I'm not listening, while bidding up everything in the meantime. And I think that's something we're going to be returning to quite a lot for the rest of this year. Maybe now that's a good time to plug next week's episode, where we have a very, very experienced economist, Frances Donald, coming on, chief economist at RBC in Canada. And we're going to want to talk to her a lot about how, and she's in Canada, so she's feeling the wrath of Trump already, but how they see it that side of the Atlantic as to what is going on. I think that's going to be a really interesting one for us to probe and push on, because I feel this is going to be a big theme for us going forward.
I think, to my mind, there's no coincidence that commodity prices have been racing higher. Now, you can argue they've got ahead of themselves and all the rest of it, and nothing goes in straight lines. But they've had a big surge, and part of that is because of this critical minerals and sort of security, trying to get sort of mineral security. And Trump basically getting control of Venezuela, as I said, has now got the world's biggest oil reserves.
And a lot of gold as well.
And a lot of gold and lots of other resources. Now, the reason everyone's talking about Greenland is Greenland don't produce a lot of oil, but they're meant to have huge deposits of rare earths. And if you think about rare earths at the moment, China produce about 70% of all the world's rare earths. They've got about 50% of the reserves, but they produce about 70% of all the rare earths that are consumed at the moment. Now, Greenland only have about 2% of that production, but it is estimated that they've probably got 20% or 25% of the world's reserves of rare earths. And that is why he's focusing on Greenland, because these rare earths go into all the technology companies, and all his Magnificent Seven desperately want to make sure that they are not going to be, held to ransom at some point by China, where they at the moment have to buy more than half of their supplies. So Greenland is really important. It's important for military reasons, because obviously it's the shortest route from Russia to America. So all ballistic missiles, intercontinental ballistic missiles, have to go over that sort of part of the world. We can monitor which submarines are going between the UK, Greenland and Iceland. So it's very good intelligence for America and NATO to see what the Russians are up to. And that's just an aside, because actually at the end of the day, like I say, if Trump can get hold of securing rights to those rare earth minerals in Greenland, that's a prize that's worth having. And it's interesting, we'll see next week, because there is a meeting set up next week with Denmark, who currently sort of basically control Greenland, and the Americans. And we'll see what happens there. But it will be very, very interesting. One space to watch. I hope he doesn't use military force, because I think it could be the end of NATO. And NATO has been a very powerful deterrent, and kept the Western world, and more importantly, places like Russia at bay.
And plus, that's your bull run well and truly over.
I think it might be, although I suspect commodity prices would go through the roof, absolutely roof it if that happened.
Well, talking about commodity prices going through the roof, shall we take this opportunity to look at the performance since our last live podcast, which was 3 weeks ago? So a reminder, this is the performance from the 17th of December until the 7th of January. And what a performance it's been. Chairman, You like to take the limelight. Go on, take us through the top three.
Well, I think that when you're in charge of the portfolio and it performs very well, then you should take the limelight. So I think it's very well deserved. But it's been an absolutely fantastic time. As Mark was saying, the big beneficiaries, I mean, everything's done well over the period, but the big beneficiaries have really been the commodity side of things. So generally on our list are commodities at the top. But the one that's right at the top is the VanEck Crypto and Blockchain Innovators ETF, which, as you know, on our list, normally it appears either at the top or at the bottom. Yeah. It doesn't do much anywhere else. It's the most volatile of things. It is up week on week, 12.1%. The BlackRock World Mining Trust, what a great job that's done. I mean, that has been absolutely superb. And that is up 11% on the week. Mm. And Wisdom Tree, the copper ETF, is up about 8%. So the bottom few, UK gilts 0 to 5 years, you'd expect that. It's virtual cash, it's small positive, that's great. Unusually, gold, you would not have thought gold would be down there given what's come out. And I think all that does is reflects that gold's had a really good run already and everything else is catching up a bit. I find that quite interesting when we come to review things going forward, over the next, for the next 3 months. I think if you'd said to me, and I was sitting at home, Venezuela's been taken over by Trump, I would expect gold to be trading a new all-time high.
Fair.
And it's not.
Yeah.
So that's an interesting point, and we'll come back to that, as I said, in a moment. And then India, as Mark has said, they've got some reasons in the short term for issues. India's a very dynamic place. I regard it as a sort of a little bit of a hedge in the portfolio in the, when it does badly, everything else does well. So I'm happy for it to do badly if that's what happens. And I say it's done badly, it's not done badly.
Exactly.
It's still up 2.5%, which is a great performance.
We're talking about the worst of our real assets there is up 2.5% in a 3-week period. I mean, this has been a real end of year rally across all assets.
Yeah, and I think it's fair to say, Mark alluded to it earlier, that we were wrong with the Santa rally. But what we should have really said is Santa to year-end rally.
Yes.
Because what we've had is we've had the rally. We've had what we thought was going to happen. Our timing was slightly out. When people had retired home to go and eat their turkey, the markets did the good work. And now, we're where we thought we were. So what we need to really be thinking about is, given we moved up our weightings as well into this period, whether that has some impact on what we think we should be doing with our portfolio going forward.
Yeah. So a 4.2% weekly or 3-weekly return over the period. That is incredible. That takes us to a total portfolio return since inception of up 14.3%. So as it's the first week of the new quarter, the Q1, it is time for our quarterly review. We're going to look back at the performances over the Q4 period, so 3 months, and let you know whether there's going to be any changes to the portfolio at the start of 2026. Gents, where would you like to start?
Well, but perhaps if we start on just thinking about some of the quarterly performances. And when I look at them here, I've actually taken quarter to quarter, so 30th of September to the end of the year. And it's just to give some idea of what some of the big movers and shakers have been. So the best performing asset of the major ones that I look at, silver, up 53%. Now, I'm personally a bit gobsmacked about that because, I've not something that I predicted. I've got some colleagues who we know very well who've been very long of silver. Well done to them. They've done a great job. But to me, why silver's done 53%, but the World Mining Trust, something we actually own, is up about 20% on the quarter. I mean, that's an unbelievably big. If you think it's a collection of lots of different companies, to be up 20% is a splendid performance. We go down to copper at 17. Best performing equity market over the quarter. FTSE 100.
Is it really?
Caps on, guys. Oh, they're on already. They're on already. And they fit so naturally. I've forgotten I got it on. They moved down to the EM at about 1.2%. But the bottom three, VanEck down 13%. But then Bitcoin was down 23% in the quarter. And Ethereum was down 28%. Now, there aren't many times when we would sit here and say, silver and copper and gold and everything's up massively and Bitcoin, Ethereum are massively down when they're all they're talking about Bitcoin being
the digital gold.
Oh,
yeah. Yeah.
So you can see that something happened there. So it's been a diverse performance dominated by those commodities. And the interesting thing for us is we took a pretty brave position when we started our portfolio construction with our position in commodities.
Mm-hmm.
I mean, most people out there do not have in a wealth management portfolio anything like the exposure to commodities that we've done. So well done, guys. I probably wouldn't have done quite as much as you guys have pushed forward. So well done on that, because that's driven things forward at a great rate. As the chairman, I take full responsibility for decisions being made, but the advice that's come in has been fantastic. But we've got 22.5% of our portfolio in commodities. We've got 67.5% of our portfolio in equities and 10% in cash and bonds. So the question for me, first of all, for us to think about with this quarterly review is 67.5% equities, 22.5% commodities, 10% cash and bonds, 14.3% overall return with a very good quarter. Do we think the balance between equities, commodities, cash and bonds is about right? Should we be changing it? What's going into your thought processes, guys, on those?
The bull case for commodities remains very much in place. As we alluded to when talking about Venezuela, Greenland, scarcity of resources, and countries led by America trying to get mineral security going forward. I don't think that's going away. And therefore, I think that although nothing goes in straight lines, any pullbacks in some of these big metal positions will probably be used by people who don't have as much as we do in their portfolios to buy those dips, as we've called them in the past. So we've had a great run. I'm therefore sort of not completely averse to maybe trimming a little bit of one of those positions. My instinct is normally to sell the things that are not doing as well. So, gold has been the laggard. Maybe we'd trim a bit of gold, but we've made a lot of money in BlackRock World Mining. It's 6 of one, half dozen of the other. The place I'm still very positive on is copper. I read this morning there's been a new sort of piece of research done by S&P Global, the Standard & Poor's global consultancy, where they believe that the demand for copper is going to increase by 50% between now and 2040. That's just 15 years. And there's going to be a massive shortfall of supplies of copper.
Yeah, 10 million shortfall.
10 million shortfall. Now this is one of the reasons we got into copper in the first place. Therefore, I actually would like, if we get opportunities to buy copper on any dips, to buy copper. So I wouldn't want to trim that at the moment. We've got 7.5% in copper. That's a great position, but I wouldn't certainly be reducing that now. Gold has been a laggard. I still think gold will make $5,000 an ounce before it hits $3,500. And off of this conversation, we've talked about that. I think that it's more likely to get to that, but it might be a bit slower than some of the other areas. So yeah, I'm sort of agnostic a bit towards gold right here, right now, but I love commodities still going forward.
I would have to agree, certainly on the copper point. It's been a long-term underperformer. And now that it's going through the new highs, then I think that continues because the backdrop just suits it really well for the fundamentals. Gold, I would take a slightly different approach because our different views on the risks around the world. I'm still feel more cautious. With a 14% earnings growth already baked into the pie in the S&P and NASDAQ, I'm not particularly looking towards US equities. It's given me my return. And I think that the risks to geopolitics have definitely increased. So gold, I'm still happy with. We're going to get, relative to Jerome Powell, the next Fed chairman is going to be a lot more loose with policy. So that plays into gold as well. So I would actually feel a lot safer in gold than I would do in other equities. But World Mining Trust has gone on an absolute tear. You can see we're up 52% since inception. The last time we were up 52% since inception,
it went.
It didn't stay
it went
there
to
long.
up 5 very quickly.
So I would agree. I'd be happy to trim the World Mining Trust because In the copper market, we're actually seeing some strikes at the moment. And that is what tends to happen when commodity prices go higher. Then the mining companies and the unions tend to argue against the companies, pay us more, pay us more. So I'd rather be in the underlying commodity than I would be in the equities. And therefore, the World Mining Trust would be my favoured reduction in risk.
We're also blessed by the fact we've got a big position, 12.5% in the FTSE 100. And the FTSE 100 has a very big sort of exposure to mining companies, particularly iron ore and copper. Now, iron ore has been a laggard. It's been pretty poor, actually. It's only just in the last couple of weeks started to move up a bit higher. I've noticed that off a low base. And copper, meanwhile, has been doing pretty well, taking out all-time highs, as has gold and silver, as we know. So I was looking at the BlackRock World Mining Trust, that split as of the end of November, because we haven't had the December one yet. Gold is the biggest position. It's about 39%. And then copper is about 19%. So it's not as big as you might think. Diversified, which includes things like silver and some of these other metals, is about 25%. But silver itself, they've only got less than 1% in. So they won't have benefited, although the performance of the overall trusts done very well, they haven't had like 25% in silver and it's doubled. It's even more impressive that actually the trust has performed as well as it has in that circumstance.
When I look at it, and it's interesting just drawing those things together, firstly, you've already mentioned, Rich, since inception, BlackRock World Mining Trust is up 52.6%. And that's gone from a period where people didn't really like commodities, so it's probably trading at a discount, to somewhere now where it's probably trading much more at its net asset value. So I think, what a great performance, and we're aiming to invite the manager of that in over this quarter and get him to come and talk to us. And so, that shows how committed we are and how much that we like it. I'm a little more concerned about some of the price action we saw over Christmas. And I'm going to draw on silver just to be the perfect example. Silver had a massive spike high over Christmas, massively up over Christmas Day, over to Boxing Day, and then gave it all back. Now, we've sat here many, many times, talked about bubbles, and we've talked about exponential price action. And if ever there was an exponential price action, that was it. So I do think we should be taking some profit out of the commodities sector. Copper has been a bit, I know it's done very well up there, but it's actually been a bit of a laggard, which is why we bought some more just before Christmas. And I'm perfectly happy with copper. That's great. No problem with that. Great idea to buy it. And we've got that on board. Gold we've reduced already to 5%. And so I don't really want to take it down anymore because, as you say, if I've got something wrong in my life, it's going to be, I haven't got enough of these things and they're going to push up more. So I think 5% shows commitment. But I'm going to suggest, therefore, and in fact, I'm going to do more than suggest because I'm the chairman, we're going to take 5% out of BlackRock World Mining Trust, take our profit, admit we've had a great time, not because we're negative on commodities, but because it's done so well, it's sensible to take some money out. Then I think Mark, I'm going now straight onto the equity side. I think Mark just made a fantastic point as well. And I wanted to come into his piece on the spicy review, but he was taking so long to get through that, I thought I couldn't give him any more time to talk. But he said, the FTSE will never trade at the ratings of the S&P. Well, actually, I don't agree with that because the reason the S&P trades at the ratings it's traded is because it's got a section which trades really high, but the rest doesn't trade really high at all, okay? What is to stop, if our view is right on commodities, that all the commodity companies, all the miners get really well bid and their price per earnings ratios go up massively and they drive a big revaluation of the FTSE. So I'm with you, Mark. When you look at the FTSE, we've got exposure there in commodities as well. So taking a bit out of BlackRock World Mining sounds perfectly sensible when I've got all that FTSE exposure as well. So let's go on to the equity side. We've got 67.5% of equities, as in the real equity markets. What are we thinking there? I'm going to go first this time, just as we can do it in order. You can go first, Rich, on cash and bonds. So on equities,
cash rich.
I'm pretty bullish on equities still. I mean, I don't see them having got out of order over Christmas. In fact, I think they were pretty disappointing over Christmas. They went up, but they didn't go up as much as we thought. First quarter is generally a very good time for equities. As people look forward to the earnings season, sell in May and go away is there for a reason. So there's all these reasons. Plus, we're going to get announced the Federal Reserve Chairman, and we all know he's going to be a dove. We all know he's going to want to cut rates. We all know every market's going to react like that. Doesn't stop the market saying, let's put some more equity performance in because we know we're going to get lower rates. I mean, we talked about people being simple. That's simple.
Thank you for that.
But that works. And which is all about this game is about what works, not about what should or shouldn't happen. It's what actually happens. And in my view, what will happen when that's announced is there'll be another fillip to the upside. Maybe that would be a chance to sell some equities. But at the moment, I'm perfectly comfortable with our equity exposure in terms of its size. When I look at what we've got in there, yeah, I can make a reason to sell a few Nikkei. They've done fantastically well. Japanese bond yields going up and all those sorts of things. But I think I'm just looking to do something there. I don't really feel like doing it. So my suggestion from me is we don't do anything to our equity pot. We stick just taking out some money out of our commodity pot, which is a bit equity-ish, but we're selling some of those commodities. We're keeping the rest of our equity pot as it is. But what do other people think?
I understand what you're saying. I feel like I'd just be doing things for a reason. But there could be an argument for doing things for a reason, and that's that we're up 14%, that we've got, that will be 67.5% equities exposure. If you add in World Mining Trust and take that as equities, it's then going to be 72.5%. Every single analyst across the street and strategist has the S&P 500 going up through 7,000 this year. Every single one. Not a single one thinks it's going to go down. We've got 14...
That's not exceptional, is it?
No.
In fairness, the start of every year, every investment bank always predicts the S&P is going up.
Not every single one.
I will guarantee you, in all the years I've looked, you can count the fingers on one hand how many times they haven't. But the point isn't whether they're going up, right? I mean, I probably share some of your your concern there.
Caution.
What we're saying is, at the moment, would you sell something now? You're making the case for over the year, maybe we've got to be a bit more cautious at some stage. What I'm asking the question is now, would you be cautious now? That's the question I'm asking.
The reason is non-farm tomorrow, non-farm payrolls.
So that's a US employment number.
US employment figures and unemployment rate. Then CPI next Tuesday, PPI Wednesday, not as important. Retail sales over Christmas. So between now and when we next meet, there are potential hurdles, albeit not major ones. So yeah, maybe we stay as we are just now, but then the end of the month, 28th of January, you've got real tech reporting season starts, and you've got the Fed rate decision as well. Personally, always being the more cautious approach, having had such an incredible up 4% in 3 weeks, I would be tempted to take another 2.5% off the S&P 500.
Remember what we always say about bull markets. They climb the wall of worry, right? So the worry is there. The time I worry is when there is no worry, right? Now, I don't see that at the moment, but I take your point.
Well, and just one worry before we go. The US has just gone into another country and kidnapped the president.
And that is without doubt a big worry. As you said earlier, if they go and walk into Greenland, then NATO's finished. And I don't know what stops Putin saying, well, I'm going to take over Estonia now and you ain't going to stop me because NATO's not there anymore, right? I think that is definitely a big risk in the scenario. Personally, I don't see that happening. The Trump is all about the deal, right? And he's been, he can get almost all he wants from Denmark and Greenland by talking to them and doing a deal on it, is my view. I may be completely misreading it. I may be putting my foot in my mouth because I'm saying I don't think he'll invade. Short of an invasion of Greenland, I'm not really that worried in the short term.
Is a potential hedge having some more exposure to defense names and having a specific defense ETF like we've got the World Mining Trust for commodities?
Well, I was looking at the performance of the defense ETFs. The big one is in America. America are the biggest beneficiaries potentially of an increase, big boost in defense spending, as well as some of the German companies. And in this country, Rolls-Royce and British Aerospace. Now, Rolls-Royce has more than doubled in the last 12 months. The big US defense ETF has gone up 60%. The last week or so, they're up over 10%. I think they're largely in the price. But I do think a more interesting angle, perhaps, is that emerging markets, funny enough, are probably slightly de-risked, ironically, because of what's happened in Venezuela. So Venezuela was always considered a very volatile country, not a place that many international investors would want to go. And actually, what's happened since the capture of the president there has basically meant that the quality, the security of bonds and other assets in Venezuela has probably gone up.
Mm-hmm.
And so, although they're going to have to issue a lot more government bonds to fund the investment in the oil industry, that is basically secured by America, ironically. And so the value of their bonds is probably going to go up in value. The price is going to go up. The yields are going to go down. And that's what we've already seen some of that already.
We're not buying Venezuelan bonds, are we?
No, I'm not. No, I'm not suggesting we do that.
You're going to lead the bond conversation. Let's not front run it.
I suppose what I'm saying is interesting that the emerging markets have had a very good run over Christmas as well. And that's partly to do with some of this. And also the fact that China, again, are doing decent things with their AI industry. DeepSeek, which is, as you know, their cheaper version of NVIDIA, had some great sort of comments out over Christmas and actually pushed the Chinese market up 5 or 6% in a couple of days. And that's the biggest part of emerging markets. So actually, I think emerging markets could continue this momentum that we're seeing. And I agree with Chris. I see very little chance. You can never say never, of course, but I see very little chance of Trump invading Greenland. When you can get the milk, why buy the cow, sort of thing. So at the end of the day.
Wow. Wow. Philosophy. My goodness me.
I don't know where that came from, frankly. But I think, the point is, if he can get his hands by giving them a load of subsidies or, sort of helping invest in huge infrastructure in Greenland, which is, by the way, traditionally, that's what China do. China want to get resources. They go into Angola or wherever they do and say, right, we're going to build you hospitals, roads, schools. And in return, we want to have guaranteed offtake 25% of all your natural resources. And deals get done like that. And that almost happened in Botswana. China almost took 100% control of all of Botswana's reserves years ago. And luckily, it was blocked by people like America and the UK said, no, hang on, you can't do that. But, a deal like that wouldn't surprise me in somewhere like Greenland, where America go and say, look, we're going to pump a load of money into your economy, build your school, infrastructure, everything you want. But in return, we want 50% of all your resources offtake. And we'll invest in the mining and everything to help you get there. So those are the sort of deals I expect to be done.
So Spice, just wanting to get to the conclusion, I'm saying that I think I'm not minded to sell the equities. I understand selling 2.5%, but actually 2.5% equity selling is not going to make a blind bit of difference if there's a problem in the world. Are you suggesting any changes?
No, I think, I still like the US. I think other markets, I like the UK still because of the reasons we talked about with the big mining exposure. But you cannot get away from the fact that in most countries, the UK is perhaps a bit of an exception here, there is fiscal stimulus coming through. China are doing it, America's doing it, Europe are doing it, and we got the one big beautiful bill, tariff rebates, AI spending benefits, still spending lots of money on it.
All right, I've heard enough.
All the efficiency to come.
Yeah, sure.
In fact, let's buy more equities. Let's buy more
He very
equities.
nearly got that in before the yellow card, but fortunately the yellow card matches his shirt.
It clashes with the shirt, I would say, even.
Cunningly disguised.
But also Venezuelan colours. Yeah. So we're in support.
So as I see it then, we've got 22.5% in commodities. I'm going to sell 5% of the BlackRock World Mining Trust. That'll take us down to 17.5%. 67.5% still in equities. Now, where I do have some sympathy with my colleague on the left, esteemed colleague, sorry, I'm sorry I wasn't showing enough respect, sir. You were in the New Year's honours list, weren't you? You're now Sir Richard.
I don't know, I was in Dubai.
For services to the podcasting industry. To me, we could do with a little bit of protection in case something goes wrong with what Trump is doing and somebody calls his bluff, somebody takes him on, somebody says, no, sorry, you can't have Greenland. He says, well, I'm going to march in there and do it anyway.
Yeah.
And I understand that concern. And I wonder whether what we should be doing is taking our IG UK Gilt 0 to 5 year UCITS fund that we have, taking that fund and taking the 5% that we've got out of commodities and buying the 7 to 10 year US Treasury ETF. My thinking goes something like this. First of all, I don't want to buy the core bond ETF because the core bond holds corporate bonds and things like that. And this is not about corporate bonds. If the world goes badly for the equity market, it'll go badly for corporate bonds as well. So I'm not falling for that trick. Mm-hmm. I want to buy US Treasuries. So if there is something that blows up, my US Treasuries will rally. At least that gives me some compensation. We'll have, at that time, we'll have 15% in that side of things. That will help. But at the same time, if we announce a new, very dovish chairman for the Fed, and the market says, we're going to get more interest rate cuts, then the 7 to 10 year area of the market will rally anyway.
Okay.
So it's a bit heads I win, tails you lose. Nothing ever works like that in reality. But it's a little better, I think. It builds a bit of protection into the portfolio and allows us to run that little bit of equity risk. Guys, what do you think about that?
I don't mind that strategy at all. I think it's quite a good strategy because, as you say, I think that whoever we get to come in to replace Jerome Powell on the Fed as the Fed chair will be more dovish. I think the markets are anticipating that, yes, as we've discussed before. But the confirmation of these things also leads to a little bit of a kicker. That's why equities, I think, will probably, on the confirmation of that, do a bit better as well. I think the only thing I'd question, and I'm playing devil's advocate a bit here rather than sort of dismissing it, is historically you've been a bit more cautious on the US dollar. Do you think moving into more dollar assets, increasing that exposure to US dollars effectively, is the right thing to do? Or I don't mind doing that because I think that the US dollar is actually going to do a bit better than people think because the growth prospects in America are increasingly better, and therefore that will suck in money from other countries and out of other currencies into the US dollar. The dollar should strengthen a bit. It's been very weak last year. I personally don't expect another weak year for the US dollar. I think it probably goes sideways to up a bit, is my view. So I don't mind that trade at all. But you were a bit more cautious on the US dollar. Do you think that puts you off? Or
I am still nervous of the US dollar. I actually think the US dollar will cheapen this year. So we've got a little bit of disagreement between the two of us on that. I'm not so major, but I just think that the US will want to cheapen the dollar. But remember, I'm buying this as a insurance trade. So it's quite likely that I'm going to lose a bit of money on the currency, but I'll make a bit on the price of bonds because prices will rally if there were more rate cuts. So net, it'll be a flat trade. So it's not there to make me money if the rest of my portfolio is making me money. Yeah. It's there to make me money if things go wrong. And if things go wrong, there'll be a flight to quality. And as we all know, with a flight to quality, the dollar will rally first with the bond market. We can then choose to change into a different currency or do whatever. But it's just an insurance trade against things going wrong. I think we've had a really good run, but we are undoubtedly approaching a more risky time with what Donald has done with Venezuela and his comments about the Western Hemisphere and about Europe and all these things. So I just think a little bit of insurance isn't a terrible thing to have at this time.
I think it summarizes the quarter quite well. Also, markets don't necessarily go up in a straight line, okay? The Q4 was a story about rotation. And it wasn't necessarily anti-American. It's just that the American assets didn't perform as well as the rest of the world. It was a pro-diversification quarter. And it was rotation, diversification. So adding to that seems to make sense.
Yeah, I mean, the other thing is, I'm just thinking on my feet a little bit, the sterling dollar rate, cable as it's called, the pound could weaken a little bit into the local elections in May. Remember, at the beginning of May, when we had Stuart Thompson talking about the outlook for 2026, he highlighted the fact that there could be some political instability because of the May elections, where particularly in Wales and Scotland, Labour are expected to take very big losses. If that comes to pass, there'll be a leadership challenge potentially for Starmer and his team, and that could lead to sterling and international investors taking money out of the UK again, particularly in a currency form and away from government bonds. because any replacement of Starmer and his team is likely to be more left-wing, more socialist, therefore likely to want to print money rather than to be more conservative with a small c and controlling finances. That could lead to the pound going weaker or lower, particularly against the dollar. So actually, thinking on my feet a bit, that trade really suits.
Okay, then just to confirm what we are doing, changes to the portfolio. We're selling 5% of the BlackRock World Mining Trust.
That's easy for you to say. Put your teeth in.
Please keep that in.
We are selling 5% of the BlackRock World Mining Trust. We're going to take that 5% and we're going to add in the 10% we've got in UK gilts, and we're going to take the whole amount and we're going to buy US 7 to 10 year treasuries. That is the move for the week. Good stuff, right? Thank you very much for joining us for the first episode of The Art of Investing of 2026. We look forward to hearing from you. If you would like to drop us an email, then send us it into
The Art of Investing at IG.com. And Happy New Year to everybody.
A very happy new year indeed. 14% of a happy new year. We will see you next week.